Welcome, everybody. My name is Frayne Olson. I'm a crop economist, marketing specialist with NDSU Extension. I'll be your host today. Thank you for joining us. This is the May 15th edition of our Agricultural Market Situation and Outlook webinar series. Today we have Brian Parman, myself, Ron Haugen, and Tim Petrie. Unfortunately, Dave Ripplinger is not able to join us today. So thank you for being here. Just as a reminder to everybody, we will be giving all of our presentations, and then we'll have some time at the very end for some questions. Please, if you can, use the Q&A function, or you can use the chat function. I'll be trying to monitor both of those, but if you can use the Q&A function, it works a little easier on our end. So if you do have any questions, feel free to type those in as we're going through, and we'll try and get to them at the very end. So with that, I will let Brian Parman start off and introduce his topic for today.
All right, thanks, Frayne. Everybody see that okay?
Yep, that looks great.
All right, cool. All right, so today I just want to do a brief talk on using some of the farm business management data that we have that has been collected over the years, and discuss some basically this talk centering around return on assets and return on equity for farming. And it's something I've been looking at over the years, and there's some troubling trends going on as far as that goes that I just want to highlight. So I've divvied this talk into statewide, and then we'll look at the Red River Valley versus farms in North Dakota off the Red River Valley. So this is statewide net farm income for North Dakota going back to 2015. And the red line there, that's the state average of all farms in the program. The green is the high 20% quintile. The yellow is the low 20%, so the bottom quintile. And then again, this red line is the average. And since 2015, net farm incomes on average have been positive, partially drug up by this high 20 quintile. But you see it here, the average in 2024 was down from 2023 by just about $20,000 or so per farm, which is considerably off from 2021 and 2022, but is actually substantially higher than years like 2019, actually a bit higher than 18, and significantly higher than 2017 and 15, which was particularly poor statewide. But then we look at the statewide return on assets and equity, so ROA and return on equity. I don't know why I have an extra R in there. Sorry about that typo. But return on assets and return on equity. Return on assets being the dark blue statewide and the light blue being return on equity. 2024, 2.7% return on assets and 1.3 rate of return on equity. And so you might say, well, how come you had a year where you have rate of return on assets higher than rate of return on equity? Well, when you have negative net incomes dragging some of that down, that can wind up happening. But you can see that outside of 2020 through 2022, these numbers for about the last 10 years have been pretty low, below 5% in most of these years as we look across it. And that is despite positive net farm incomes, to the tune of north of $100,000 most years statewide. So this is the rate of return on assets and equity for non-Red River Valley farms. So farms that are within our data sets and within the scope of what we collect that are not considered in the Red River Valley, north or south or on the Minnesota side. And so the top bar graph shows net farm incomes for non-Red River Valley farms. And the bottom bar chart shows the rates of returns on equity and assets. And I want you to notice here, you look 2023 to 2024. 2024 actually had a higher net farm income off the valley than 2023 did. And I know there's some inflation in there, but not a lot in one year. And yet 2024's rates of returns on assets and equity was significantly lower in 24 than 23. So you had higher net income in 24 for off valley farms. I know I said statewide it was down. That's because this doesn't include some of the valley farms, which were lower. But 2023 had higher return on assets and equity. And if we look back historically, let's take a look at 2024, a net farm income year that was comparable, let's say 2016. It had a lower net farm income a bit, and I know there's some inflationary factors in there, but you look at the rate of return on assets and equity in those years, and it was north of 5% for both. Rate of return on equity higher, well over 5%, and then rate of return on assets right around 5%. And let's even take into account, let's look at the best year that North Dakota's had on record, 2022, in terms of net farm incomes. And you see and so again, non-Red River Valley, you see the rates of return on assets was just over 10%, and rate of return on equity just over 15. But you compare that with 2012, and the rates of return on assets and equity were significantly higher in 2012, and even higher in 2010, which wasn't near as strong a net farm income year as 2022 was, or 2021 for that matter. And we can even look just at these 2 years here, 2021 versus 2022. 2022, a higher net farm income year, but 2021, then 2021, that is, and 2021 had a higher rate of return on equity and a higher rate of return on assets. All right, so let's look at the Red River Valley now. Okay, so again, 2022, a fairly strong year. And here's the rates of returns on equity. And I don't know again why I put that R in there. Rate of return on assets is black, rate of return on equity is green. Rate of return on equity here, 2022 is pretty good, approaching, just south of 20%. But look at how much stronger 2012 was. And you go back here into 2011, that looks a lot more like 2022, even though the net farm income wasn't nearly as high those years past. Again, there's some inflation adjustment in there, but inflation alone doesn't justify the disparity between rates of returns on assets and equity that had occurred historically, even with lower net incomes than happening today. So, what are the primary farm assets? Well, really, you can divide it into two as far as crop production goes. Land accounts for about 83.5% of all farm assets. Okay. And then you add in machinery, which could be anywhere between 8.5 and 9.5. That's the estimates of total farm assets, and you get the vast majority of all assets in farming right there. I mean, if it is indeed 9.5%, you're looking at 83.5 coming from land, and then 9.5 there. So 84, so 93% of all farm assets are comprised of machinery and land, right? So that's the vast majority, a big chunk. Well, what's happened with machinery costs? Well, this is taken from the data, and this is a statewide average. So if you went in and looked at our enterprise budgets from 2024, each region is going to be slightly higher or potentially lower than this. This is the average of all the regions combined within the data set. And the dollars per acre. So what I did when this calculation was included lease expenses as well as depreciation. So equipment, this does not include fuel, oil, lube, any of that kind of stuff, just machinery itself. And since 2000, machinery costs are up about per acre on a per acre basis 400%. All right. And actually, since about 2010, 2011, machinery costs have doubled. Okay, so in 14 years or so, machinery cost per acre have doubled. And by and large, North Dakota farm size hasn't really changed very much in total acres during that period of time. And yet machinery costs, the expense per acre that goes into either leasing or buying, financing, and then depreciating new equipment is starting to approach $42, $43 an acre on average statewide. And then this portion here, going back to talking about equipment, this is from an article that came out of Farm Doc Daily back in January, and it's showing some of their data out of Illinois on the cost per crop machinery cost per acre. And what the trend had been, and the justification for it was, yes, machinery costs had been going up like per unit, per tractor, per combine, whatever, for a planter or whatever the case may be. But you were able to either be more efficient, roll over more acres, whatever the case may be, and your machinery cost per acre was going down. as was the crop machinery investment per acre. So that would be like a purchase price or something. So you had your operating costs were going down per acre as well as potential investment. Well, that completely reversed course in 2020 to 2021. And you can see it here from this graph. And you see crop machinery cost per acre in some down around the I states, corn going up by 2023. That number was approaching $190 an acre crop machinery cost on corn, and then soybeans down around, $110, $115 an acre, and that average going up significantly. Then the other portion, of course, is land prices, as I said. So North Dakota cropland values since 2021 are up 46%. And just last year, up just over 10.5%, which I've said in some of the news releases and articles that have come out. I was surprised to actually see it go up that much in the last year. Now, I will mention that there's been some anecdotal evidence of softening in the land market, some reserves not met at auctions, in other words, no sales, and some reservations about selling, seeing some of these prices go and negotiated prices lower. But the fact still remains that you look at the last 4 years and the increase in land prices has been substantial. And then if you go back to the tail end of this graph, if you go from about 2013 back to 2008, there was another significant increase in land prices during that period, with there in between being a flattening out. And so what's happened is that land prices and machinery costs have been growing essentially faster than incomes have. Okay, so it's not been some inflationary increase, nor has it been an increase based on the, as Frayne would discuss, yield trends, where you get a yield trends have been going up over the last several decades. So machinery costs have been going up faster than those yield trends would predict, as well as have land prices significantly faster. And the rapid growth in these two largest asset classes suggests that net incomes are not the primary drivers of what's pushing land prices higher and what's pushing equipment costs higher. Okay. They're not the reason for the appreciation of assets. Now, on the land side, speculation, as we know, it explains a lot of the growth in farmland prices, where speculation is, we expect that land prices are going to go up in the next few years. So even though income isn't really justifying what we're paying for it, that's okay, because if we get this appreciation in 2, 3, 5, 7 years, the income will be a portion of it, but that just growth in value in and of itself will explain it, or financially justify the purchase. There really isn't a speculative component to equipment prices, okay? That's a depreciable asset. And one of the questions I've been asking as I've talked about equipment prices over the last year and a half, especially since they've been increasing so rapidly, is at what point do equipment prices, are yields and production just not supportive of the continued growth in equipment prices, outpacing the yield curve or the growth in yields? At what point is it outpacing it to where it's becomes a lot less affordable, or becomes a bigger hindrance than it already is? And I don't know where that point's coming in, or necessarily the solution for it, but it is something to watch, that what we've seen here over the last few years has been this just rapid jump in equipment prices that just it hasn't been justified by net incomes, as you've seen from the graphs below. And it's not just these last few years. This trend has been occurring now for 5, 6, 7 years, where it's just outpacing it, and these equipment costs per acre continue to increase. So that's something to watch and something to think about there. And you know, we talk about a lot, especially on my side as a production economist, cost cutting measures. And right now, there just are not a lot of other avenues or a lot of components that can be trimmed to generate some cost savings. And with equipment and land being such a big component of overall costs, where would the cost savings come as far as those two entities go? So with that, I just wanted to show, sort of what's trending there, and I guess what I would say at the end, the real concern there is how weak the margin is, or how thin the margin is now with farm assets overall. And how high incomes actually have to go now to drive a significant ROA or ROE on most of our large farm purchases. So with that, I'm going to go ahead and turn it over to Dr. Olson, our second presenter, and thank you guys very much. I'll be on at the end to answer any questions.
I'm glad to be with you again today. I'll talk about the May USDA reports, as well as give a brief update on some of the other trade issues that are going on, and again, just to make sure that everybody's staying current on what's going on. So, there we go. Just a quick recap. This is the things I'm going to be hitting on pretty quickly here. Is USDA, the WASDE report itself, the World Agricultural Supply Demand Estimates, was slightly positive for corn and soybeans and slightly negative for wheat. So not a lot of shock value, but it did put a little bit of support into corn and beans, a little bit of downward pressure on wheat, and I'll explain that in just a minute. Again, as everybody knows, U.S. trade and tariff policy continues to evolve very rapidly. There's a lot of information that's coming out every day. It's really hard to kind of sort and filter through all of that. I'm going to do my best to try and summarize that to make sure that everybody stays focused on those core issues. And then the last thing I do want to remind, I said this last time as well, when we come to tariff and trade, we automatically jump to how does this impact agriculture, and whether it be the markets or input prices. And that's obviously important. However, the main driving force behind these trade issues and tariff discussions is not because of agriculture. Agriculture is a component to it, but there's a lot of other pieces and there's a lot of other economic forces at play. So I just want to remind everyone, agriculture is important. Yes, it's going to be it can be very sensitive topics within trade negotiations. But the real pressure behind trying to change these trade agreements, et cetera, is not primarily because of agriculture. So let's dive right in. So we're at the stage of the year where USDA is updating numbers not only for old crop, the crop that was harvested in the bin yet, as well as some of the new crop, the crop that's being planted today. So this is the old crop information for corn, soybeans, and wheat, and this is all wheat. There really weren't a lot of changes. There's a few adjustments. There's some kind of nibbling around the edges. There were some updates. On the wheat side, so just to remind everybody, the blue row on the very top is the numbers that the trade was expecting to see. The black lines toward the black row towards the bottom is what was reported last month. And then the red is what we got as of Monday. So usually what I recommend is you compare the blue and the red because they were expecting to see this. What did they actually see? For wheat, for old crop wheat, actually took a little nibble out of the ending stock. So we reduced ending stocks by a small amount. There was a small change in food consumption. This is the domestic food portion of it. A slight increase. That's why we took it down 5 billion bushels. Or 5 million bushels, excuse me. The corn was a little bit of a surprise. The average trade estimate was we were going to take our ending stocks for corn down a little bit, but it came down a lot more than people had expected. Okay, now this isn't again a substantial change, but for month-to-month adjustments, this was pretty significant. And the main reason for corn was that USDA's annual 12-month forecast was, I think, finally recognizing that we've had a much better corn export season than we have in the last couple of years. So this has really been a very good corn export year. And our actual corn exports and export sales have been running ahead of what the USDA forecast was. So I think this is one of those months where they decided, well, we better catch up because now all of a sudden this isn't just a simple shifting in time where just people are buying early and then they'll back off and not buy as much later on, but it was an adjustment upwards where we're going to see a total export sales higher than expected, which then brings down our ending stocks. And for soybeans, kind of a similar story. There was some small adjustments. Most of that was in the exports number. And it wasn't the exports to China, it was exports to other destinations. So because soybean prices have been coming down, we've been able to sell a little bit more to a lot of different countries, and those accumulated export sales are starting to show up. So again, USDA was expecting to see a little bit of an increase in exports or a decrease in ending stocks, and we got a little bit more than they had expected. For the new crop, this is May is the first month that WASDE officially or USDA officially comes out with the new crop estimates. So this is the first month where we get official information on the 25-26 crop or new crop, the one that we're planting now today. I wanted to start with the production side because there's been a lot of focus and discussion and debate about the production area. So if you look at what the average trade estimates were in the blue versus what we actually got in the red, they're very, very close. And usually what happens this early in the season, we tend to see some very wide variation or wide ranges when you look at the highest reported value versus the lowest reported value. And we did get that when you look across the row at some of the variation we had, especially in total production. However, the averages came out pretty close. And part of the reason for that is most people, most analysts and traders, those that do this as their job, understand the general process and methodology that USDA uses to come up with these initial numbers, especially on the production side. Because we had our March 31 planting intentions report, or we got an estimate of planted acreage. We usually subtract off what's that normal relationship between planted and harvested acreage, and we put in a trend line yield. And so the 181 for corn, even though a lot of people are going to criticize that and saying, how can USDA forecast a record large national average yield this early in the year? It's simply because we have a trend line yield. Okay, so if you look at the long-term growth rate that we've had in our corn yields over time, and you add about 1.5 bushels, almost 2 bushels to the trend line, the average that we would see from last year, you get 181. So I don't have a problem with the yield forecasts, even though for some people that seems to be a sticking point. So you take the yield times what you expect for harvested acreage, and your total production numbers are going to come pretty close. So it's a math thing. So there was really no surprises on the production side of the ledger. Well, what about on the consumption side? So if we get to the bottom line, what do we expect for ending stocks? So we're taking production minus consumption or total use. In many ways, for corn and soybeans, the total usage numbers seem to be a little higher than what the trade was expecting. So let's go through this very quickly. Again, blue row on top is what the trade was expecting to see. The red line on the bottom is, or red row on the bottom is what we actually got. The USDA came out with a little bit higher ending stocks than what the trade was expecting. Again, I do think most of that is because of some differences of opinion when it comes to exports and potential export pace. So USDA was a little bit more conservative on their forecast for exports. And again, when you compare what they're forecasting now versus what we actually see for this current marketing year, they're very similar, but a small decrease. Now for corn, this is where, again, I think people were surprised. They were expecting about a 2 billion bushel carryout, and they had about 1.8 billion bushel carryout. Or this, again, this is a forecast for how much grain we're going to have in the bin by the time we get to harvest next year. And again, part of that was a slight increase in exports. There was a slight adjustment, upward movement in the feed and residual number compared to where we are today. Again, not dramatic. These aren't drastic changes or drastic shifts. The other thing that USDA did mention and has been forecasting, projecting, talking about for a long time is the fact that they do include changes in trade policy as they do their forecasts. So if there's a change in trade policy, they include those changes in the next forecast. So they're using the trade policy at the time that they run their models, at the time that they do their estimates. So I think given some of the tariff issues that were going on, I think there were people that were expecting that our forecasts for corn and soybean exports would be a little bit lower than they actually were. And my opinion, my view is one of the reasons that did not happen is because a lot of the countries, with the exception of China, a lot of the countries that we deal with have not provided retaliatory tariffs. We have put tariffs on them or proposed tariffs on those countries, but so far, at least for agricultural purposes, there hasn't been retaliation. And I'm going to go through that in a little bit more detail in just a few moments. So a little bit price negative for wheat because the forecast for ending stocks is a little bit bigger than we thought, but a little bit more positive for corn and soybeans. Again, those differences between what the trade was expecting and what the actual numbers were primarily due to differences in export pace. Now, what about South American production? The really quick and short answer is no change. So USDA has not adjusted or changed their expectation for total production, in this case metric tons, for corn, soybeans out of Brazil and Argentina for quite a while. If you do notice, there was a small increase in the corn production out of Brazil. Okay, and so they've been at 126 million metric tons for quite a while. They did increase that number slightly, and I think most of that is because the safrinha crop, or the second crop corn, the one that's growing right now, it looks in very good condition, and I think they're anticipating if these weather conditions hold, that they're going to have a little bit larger production than first expected. So there was one little tweak, but in general, those numbers are very, very stable. So let's jump into the trade and trade negotiations. I want to give everybody kind of an update on what's happening here. One of the things that is frustrating for me is that you've got to be very careful as you listen to the news reports, as you listen to the statements and the interviews of not only our political leadership, but also those that are doing kind of analysis of trade and trade negotiations. You got to be very careful about the terminology they're using, okay? So far, we have made progress in the sense that this tit for tat strategy, this we're going to put tariffs on you and then you retaliate, and we keep accelerating and exaggerating or ramping up the efforts and the energy in leading potentially to a trade war is now backing off. That some of those initial really large increases in tariff and tariff rates are now being paused or being reduced, which is a good thing. So we're bringing the anxiety level down a little bit. But just because people have agreed to stabilize or reduce the tariffs doesn't mean that we have a deal. Okay, so I get a little frustrated with this terminology, we have a deal. Okay, so with the United Kingdom, with Britain, we have an economic prosperity deal. Okay, and all that does is it defines the terms, basically what are the things that we're going to look at for negotiations to develop a trade agreement. We do not have a trade agreement in place with Great Britain or United Kingdom. We've actually been negotiating a trade agreement with the UK for a couple of years. What we've done now is they have redefined or refocused those negotiations on several key areas. Okay, so the agreement, the deal that was announced with the United Kingdom was to redefine these negotiations, to redefine the specific areas where we're going to target to move forward within a formal trade agreement. So I want to be really careful. We do not have a signed written agreement where the trade agreement is finalized. That's still many, many, many months off. So this will be a continuing story and something we'll have to be monitoring very closely. With Japan, yes, we've agreed to reduce the heat, right? We're taking some of those tariffs down, not for steel and aluminum and not for automobiles, but we are negotiating with Japan. We've already had 2 rounds of very specific direct talks between the United States and Japan, but these negotiations continue. And again, not long ago, we did finalize a bilateral trade agreement with Japan. And what we're doing now is renegotiating some of those terms and conditions. Okay, so we continue to negotiate. We don't have a new agreement yet. With Mexico, we haven't talked about Mexico and Canada recently. Again, the 25% tariffs that the United States put on products coming in from Mexico and Canada are still in place. Okay, Mexico announced not long after that that they would not retaliate, at least not yet. Now, we don't know if there are formal discussions and negotiations going on with modifications or any kind of new agreement with Mexico, or if that includes the USMCA, the US Mexico Canada Agreement. The same thing then with Canada. I know that the new Prime Minister of Canada did travel to Washington, D.C., sat down with President Trump, and they had a good discussion. But there was really no major announcements that came out of that. So we have a 25% tariff on Canadian products coming into the US, including a 10% tariff on crude oil. That Canada has retaliated, usually at a 25% level, for a selected items. It's not a broad base covering everything that goes into Canada. There are quite a few agricultural products that are included in that. So I don't know formally if there are discussions going on. I can't say that they are. My personal suspicion is, my personal guess is that they are being talked about, that there are low level or at least behind the scenes negotiations going on and discussions, but there's been no formal announcement of that. And so any kind of trade agreement or revised trade agreement between Mexico and Canada might still be several months, if not years off. There are trade talks formally that have been started with Vietnam. We don't know, we don't get a lot of updates on that. Vietnam is one of those growing markets we have, in particular for some of our agricultural products, for soy as well as soybeans and corn and wheat. India has been really an interesting one to watch, in my opinion. Again, there's not an official trade agreement with India. All we have agreed is they've established what they call the terms of reference for future negotiations. So they've gotten together, President Trump, President Modi of India have gotten together. They've agreed on what are those core areas they're going to focus on. They've agreed that these are goals and ambitions for developing a new or refined trade agreement, but they're still talking. There's no formal trade agreement in place. Okay, and finally, the one that everybody wants to talk about is China. Yes, there was a mutual agreement just a few days ago, agreement between the United States and China that they were going to reduce and pause any additional tariffs for 90 days to give people a chance, both the US and China, to be able to start more negotiations and see if we can come to some agreement on the basic concepts and goals for any kind of new trade agreement. So the United States reduced their import tariffs, the Chinese products, so anything coming from China was at 145%. That got reduced now to 30% for 90 days. On the flip side, China, which had a tariff on any product entering, any US product entering China at 125%, has now been reduced to 10%, again for 90-day pause. I won't go into the details unless there's questions, but there's a little thing called this de minimis tariff. That rate went from 120% down to 54%. That's usually for those smaller transactions, products that are being directly shipped from China into the United States. Now, there are some Chinese non-tariff trade barriers. So there's other ways to prevent US products from coming into China. Some of those have been removed or reduced, but we really don't have any details. There was some comments and some statements made to the public that there had been some changes to this, but I haven't seen anything or found anything to detail what specific products and were agricultural products included in that. So the moral is the status of the actual trade negotiations is still unknown. I'm sure and confident that there are discussions taking place. There are things happening behind the scenes, but again, we don't have any direct confirmation on any kind of an agreement or any kind of movement forward on an actual trade agreement. So we have to be very careful about saying, yes, we've agreed to talk. Yes, we've agreed what we're going to negotiate and what our goals are for these negotiations, but we have not signed any kind of an agreements. And so as I've looked back in history, as I've looked back over time, it usually takes anywhere from 4 to 36 months for the US to negotiate and actually sign a brand new trade agreement, the formal agreement. The average is it takes about 18 months. The phase one agreement, the last time we had a trade war with China, it took 18 months to negotiate that phase one agreement, which which covered a lot of areas, but was actually not very detailed. Okay, so the actual negotiations, the time it's going to take from now until we have a signed agreement can still take a while. So this is going to be a conversation and a discussion we're going to have for an extended period of time. So with that, I will stop my screen share. I will hand things over to Tim Petrie.
Well, good afternoon, everybody. Sorry for the problem. Both Ron and I had our computers update today and we're having all kinds of problems. But I'm going to follow up a little bit on what Frayne was talking about with the quickly with the tariff situation for the meat industry. And he had a very good lead in there. But uh, basically, I've showed you this chart before. And so in purple is just the percentage tariffs that we face for beef, pork, and chicken. And again, for beef, you see down there in fourth and fifth place are Canada and Mexico. And then for, pork, Mexico is number one and Canada number four. And then chicken, Mexico and Canada are one or two. So the situation with them is it's those products are covered under the USMCA. So there are no tariffs on those products and they are moving freely. Go back up to beef. Uh, we are in negotiation with Korea, but we have, a trade agreement with them settled back under the previous administration. So there's a 2.7% on beef. Japan, again, as Frayne said, we settled back in the previous administration on a trade agreement with Japan. And you might think that 21.6% is kind of high, but it was quite a bit higher than that before in the 30s. And the trade agreement that we have now in place is that we're going to 0% in 5 years. And so negotiations are going on over there, and whether they'll reduce this one, I don't know. Japan has been our number one or two customer for many, many years, even at this tariff rate. So things are moving very well to Japan on the beef side. And going over, let's just switch over to pork. Same thing. There's a zero tariff on for Japan on and pork as well. So things are going along there. In the case then of China, that's our third best customer for all of them. Frayne mentioned that we now are sending no beef, pork, or chicken to China. And there was the tariffs kept going up, and we did have 147% tariff on China. That now has been reduced to 32%, but China has not approved any packing plants in for beef to send beef to China, and so no beef is going, even though it's only 32%, and the 32% would still cause not much to go there, if any. And over on the pork side, it's the same thing there. We were at 172% tariff on pork. Now they lowered it to 57%. And there are packing plants approved that they did approve, but again, nothing is moving there and likely will not move there. I don't have under chicken, I don't have the percentage because there are a whole bunch of different percentages for cuts. Chicken paws are different, chicken quarters are different, whole chickens and so on and so on, but it's still high enough that that none is moving, and it looks like now that nothing will continue to move because it's by container and it's just too high. And so but from a price standpoint that we'll get into now, we have seen, even though China's out and China's a good customer for us, we are moving product to those other countries in very good quantities. In some cases like Korea, maybe even a little bit higher on beef and so on. So hasn't had much of a price effect, as we'll see here. Here's fed steers and continue to move at record high levels. The red line there is this year, and then the lighter blue line is last year. And so we'll look at the cutout in a minute, but demand is holding very, very well, and talk about that when we get there. Last week, the the 5 area fed steer on a live weight basis were right up almost 225, 224.80. So far, very limited trade this week, but it traded higher at 227 to 229.50. So on the average, it'll probably be up even a little bit this week. And the red dots there are the futures indicating that seasonal pattern when they do fall off, but still, as of now, at record high levels. USDA in the last WASDE predicting 214 for an average for the year. But again, like Frayne said, that's as of this point in time, assuming that everything except for China is the same. And so, beef demand is holding very, very well there. And, higher fed cattle prices and those futures are supportive to feeder cattle. And, on a carcass basis, then we're up there last week at 356, which is just, again, record high. The cutout value is what the packers can sell the meat for. And this is a good indication of beef demand because this is what the wholesalers and retailers are willing to pay to limit the quantity and or to move the quantity. And you see, again, this mirrors fed cattle prices because if they can sell it for more, they can pay more for fed cattle. And interestingly enough, beef production in the first quarter, January, February, March, beef production was the same as last year with carcass weights that are averaging 25 to 30 pounds heavier than last year. So we had the same amount of beef, but we are able to sell it at higher prices, means demand is very, very strong, which is somewhat surprising, at least to some, given the economy and the uncertainty and possible inflation and so on. And beef is the highest priced meat commodity and so on. So that's been good news for the industry. Again, there are headwinds into the future, possibly on the export market and what's going to happen with the economy and so on. But, so far, record high there, and that's funneling back to fed cattle prices. Just something again, a recent announcement that we talked about before back in November when the U.S. border was closed to cattle, live cattle. Mainly, this would just be is feeder cattle coming in from Mexico back in just May 11th. Then Secretary Rollins again suspended all cattle, horses, and bison coming this way, and so that as of now is going back to zero, is supportive to feeder cattle prices, particularly in the southern plains, because the feedlots down in Texas and Oklahoma kind of depend on these cattle to keep their feedlots full. And it went to zero. I was on is a call with USDA and some of my counterparts yesterday, and they think this is probably going to last a while. The screwworm is still 700 miles away from the U.S. border, but it has moved up into Mexico more than we would like. And Secretary Rollins wants to get Mexico's attention. The way you control it is to release sterile male flies. And we have been producing them and giving them to Mexico and even distributing, but she thinks they're a little bit lackluster, I guess you might say, and getting down there. And so as of now, the border is closed. And you see, typically we would be getting about 25,000 during this time of the year, 20 to 25,000 head of feeder cattle from Mexico. That's going to go to zero. And if you go way down to the bottom right, it is very, very dry, a severe drought down in northern Mexico. And so are wanting to move cattle because they don't have feed. And so that's, from their standpoint, they are blocked now. But from our standpoint, probably supportive to feeder cattle because there will be less of them. So we go and look at the heavyweight yearling background of cattle being sold now, again mirroring fed cattle prices, throughout the year at record high. And last week up there in North Dakota, again, we've just about sold all our backgrounded steers. Some heifers are selling, but the USDA is even backing off on reporting our markets here because the volume is so low on cattle, but the few that sold are still selling very, very well up there at $315. And then again, there's the futures market. By the way, I didn't mention it on fed cattle. Fed cattle futures are down, $2 to $3 or so today. And this is yesterday's feeder cattle there where May was at right up there at at 300, and they're off a little bit more on the futures market here in feeder cattle in a minute due to some profit taking by funds. But again, prices, even though we're not into China, are have staying pretty well. And again, we've got a short supply of feeder cattle with the 6 straight years of declining cow herds. So that's certainly a part of the picture, as well as corn staying at moderate levels. So, here's the August feeder cattle, and this is just through yesterday, but you see as of Wednesday, Tuesday and Wednesday, we were up there at record high levels. The futures there are the bar charts, and then the green is the CME cash settlement price, which is the average cash price for US. They're in at 302. You see that average cash price is lower than our prices up here in North Dakota, because we tend to be at the near the top of the range, and these are all the Texas, Oklahoma, SoCal cattle average. But anyway, at all-time record high prices. So what happened then yesterday was we got to all-time contract and record high prices up there. 307.67 I think was that top price, and some of the funds then decided to to take some profits, and so one bails and then the other bails. So then the market kind of went down yesterday, and it's down today pretty heavily. The last I looked, $5 to $6. So from the extreme top back there on Wednesday to what they are now, we're down $10 or $12. But that's happened before. It happened back in April, and we get to those record high levels, and there's some profit taking going on there, and then it kind of mushrooms down. But the cash market, where the futures are below the cash market now, so that's kind of a support both on the fed cattle and on the feeder cattle side. Lamb prices I've talked about in the past too, and we're just mirroring last year as well. And so, despite lamb prices that are at relatively high levels too, the product is moving, and lamb prices are probably reaching their seasonal highs like they did last year and usually do. And then we saw a weakness last year, and probably see some seasonal weakness again on that is a normal supply and demand seasonal thing there. So, just want to end up here with some good news that it is raining. Here's the rain amounts across North Dakota as of about 12:30, I guess, or so. And so you see some of the dry areas in western North Dakota are getting some rain. Unfortunately, way out in far western North Dakota, where it's really, really dry, the rains quite haven't hit there yet. I was on a call with Daryl Richardson, our meteorologist, today, and he said he thinks they'll get some movement over there, but the major rains, down there at Fort Yates, over 4 inches, and up to 2 to almost 3 inches on up, that's going to be the major event. Some will hit eastern North Dakota as well, but he doesn't expect as much. But at least we know it can rain, and in some of those dry areas, it is raining.
So, okay, I'm going to talk about the livestock forage program, the LFP, and I've got some FSA updates for you as well today. A lot of things going on here. As we remember, the LFP program was available to livestock producers and that have eligible areas and eligible livestock, and the payments were based on the drought monitor. And there's losses that are calculated, and they're based on a so-called monthly payment, and it's whether it could be a 1, 3, 4, or 5 monthly payment, and then times 60%. Okay, so here are the various livestock that you can collect this money on. Beef and dairy cattle, of course, but there's all kinds of other livestock. Yeah, ostrich, goats, sheep that you can also collect this on. As a producer, you must have a contract or if you're leasing the land, and you must have it must be at least 60 days before the qualifying disaster. And if it's pasture land, it has to be rented, of course, by that time. It has to be physically located in the eligible county, and then you need to justify your claim. Application is 2025, and it goes until 30 days after the end of the year, so January 30th, 2026. There's people that have already applied for that money already now in western North Dakota. there is a payment limitation of 125,000, and you still have to have the 900,000 AGI requirement as well. You have to have less than that. And here are the indexes here, or the severities: D2, D3, D2, D3, and D4. So you need to qualify for one of these times here. And if you look at the most recent drought monitor, this actually isn't the most recent, but the drought monitor that came out today really didn't change that much. And I don't know if the rain affected it. This red dot is the worst. That's the extreme drought. So you can see it actually touches about 6 counties there, 6 or 7 counties. And so those are the ones that are eligible for payments. You can see here the ones in kind of the orange, the darker orange color, those 5 counties, they get 4 payments. And Williams and Golden Valley, they get 3 payments. If Williams gets in D3 for another 2 weeks, that'll change to 4. And if Golden Valley, I think it's another 3 weeks, and it'll change to 4. Now, this could actually, if the drought persists, it could actually change to the maximum of 5. If you apply for this program, you will get this payment regardless, even if it starts raining and it doesn't get any higher than this. And if it goes to a higher monthly payment, you will get that. Extension service, we have a calculator online to calculate your estimated payment. It's pretty simple. You just put in, it's an Excel spreadsheet. You just put in your name and you put in your state and your county. We have it so we can choose from Montana and South Dakota as well. In this simple example here, we just have 100 head of beef and of adults and 20 head of non-adults. And these are the rates that were calculated this year: 41.40 for adults. And so by doing these calculations, you could potentially be eligible for 47.61. The next part of the calculator, you need to put in the acres of your pasture, native and improved, and you need to take the lesser of those two. So going back here, 47.61, based on your acreages, it's 57.04. You take the lesser of that times 60%, and this would be Williams County example, three payments, and then they subtract off 5.7% sequestration, an $8,081 payment based on this. So there's a calculator online. You go to the extension website to farm management, and you can find that. Here's the actual link to get to that. I have some more news. Those 6 counties actually got declared by the secretary as disaster areas. So that throws them into another whole realm. So that would be Billings, Dunn, McKenzie, McLean, Montreal, and Williams, and any counties adjacent to that. Burke, Burley, Divide, Golden Valley, McHenry, Mercer, Oliver, Sheridan, Slope, Stark, and Ward all got into that too. And just because of that, a lot of things get triggered, FSA emergency loans and such. One of the things that gets triggered is the tax treatment. If you have to sell livestock because of the drought, the IRS code 1033E and 451G, those have been in place for many, many years. The 1033E, just the red part here, if a declaration is not necessary to collect this, but it's only for draft or breeding purposes. If they do have a declaration, you don't have to replace those animals for 4 years. Otherwise, it's 2 years. The 451G, that's for all types of livestock, but there you must have a federally recognized declaration, which it has been now for those particular counties. Also, USDA just recently announced that they're going to have some more money for the MASE program, the Marketing Assistant for Specialty Crops, and that's fruits and vegetables. In North Dakota, it's basically dry bean producers can get this money. They paid out $900 million the first round. They got another $1.3 billion that they're going to pay out now. So that's something that you want to make sure, if you're a dry bean producer, that you need to get a handle on. Also, we're also wondering about that disaster aid that was passed before Biden left office, and what's happening with that money. As you know, USDA did pay out that in the process of paying out that $10 billion, the ECAP, Emergency Commodity Assistance Program. But we're always wondering, well, what about this other disaster money? Well, it's a little more complicated to roll that out. I don't know how they're going to do it, but they announced that they will be doing it. So this is kind of an announcement of an announcement. I was speculating that it would probably be like the ERP program of years past, but we don't know. That 21 billion targets losses for 23 and 24 due to droughts, hurricanes, floods, and wildfires. 2 billion of that is earmarked for livestock losses for droughts, wildfires, and floods. And there's another 220 million distributed to smaller ag states that don't have as much farm income and acreage. Also, just recently, a couple days ago, USDA announced that they will open up the General and Continuous CRP program. It started May 1. It's a short turnaround. You need to get signed up by June 6th. So that's pretty quick. If you're interested in that, you got to get on that as well. So those are our USDA updates. Always contact your FSA office for further information. So with that, that was my quick presentation here of the updates. I will stop sharing and I will turn it over to Frayne to close out our program today.
All right. We did have one question that came in regarding the revenues or the income that comes in from tariffs. Brian Parman was able to find a reference for that. So that reference is in the chat if anybody is really interested and wants to click on that to start following the revenues that are generated from our
Yeah, one of the
tariff
things about
structures.
that is by item is going to be awful tough to parse out. I'm
Yep.
actually looking at a zip file that I got from, well, the Department of the Treasury and everything else and Customs, US Customs, and going through that and figuring out uh it I'm on line 7,500 and then over on column, it's big. So would it be possible to do what was asked? Maybe, but I mean, the database. There's so many things that come into the U.S. Parsing out what's what is extremely difficult. So the best I could do to answer that question was the Treasury puts out a monthly cash outlays statement, and they amalgamate all the customs and duties collected by the U.S. Customs, and that's the tariffs. So in the documents, if you are looking up tariff information, if you use the word duties instead, that's probably where you're going to find the information instead of under tariffs.
All right. Thank you, Brian. And thank you for the question too.
Mhm.
I'll give you just another minute or so here to think about any other questions or anything you want to put in the chat or the Q&A function. I do just want to remind everybody that our next regularly scheduled webinar for the Ag Situation Outlook webinars will be on June 12th. That's Thursday, June 12th. At this time, we don't have any additional special webinars for tariff and tariff updates. Given where we are right now with the 90-day pause on a lot of the discussions. A lot of the discussions are behind the scenes, as I mentioned in my report. So as of today, there's no special update on tariffs that is currently scheduled. If something does come up, if there is a major shift or change, obviously we can send messages out to you all and as you've registered now, and we'll get that information to you. But our next regularly scheduled meeting our session will be on Thursday, June 12th. That will also be the day that we get the WASDE report. So I'm going to have a quick turnaround time. I don't see any other.
I just
Good.
want to clarify and reiterate what Ron was saying. Dairy cattle are on there, but of course they have to be grazing animals, which Ron showed in his spreadsheet. If they're dry lotted, which a lot of dairy cattle are now, then they do not qualify. You have to have corresponding pasture land with the carrying capacity that shows for each county in order to collect, and then you collect the largest of the two. So just keep that in mind. And even for those other ostriches, whatever, you have to have, they have to be grazing.
Free range ostrich.
There you go.
All right. Any other comments or statements from the crew here? Again, I don't see any additional questions. All right. Seeing none, thank you very much for attending today. Have a great day, and we'll see you in about a month.